Mutual funds come in various types to suit different investment objectives and risk tolerances. Equity funds invest primarily in stocks, offering growth potential but higher volatility. Bond funds focus on fixed income securities, providing more stability and regular income, but typically lower returns. Balanced or hybrid funds combine both stocks and bonds to achieve moderate risk and return profiles. Index funds passively track market indices like the S&P 500, offering broad market exposure with low fees. Actively managed funds have portfolio managers who try to outperform the market through research and strategic trading. Specialty funds focus on specific sectors, geographic regions, or investment strategies, offering targeted exposure. Money market funds invest in short-term, low-risk securities like treasury bills, providing high liquidity and capital preservation. Let's compare these fund types based on their risk and potential return profiles. Regardless of the type, all mutual funds share a common feature. They pool money from multiple investors to create a diversified portfolio. Net asset value, or NAV, is how the price of a mutual fund share is determined. NAV is calculated with a simple formula: the total value of all securities in the fund minus any liabilities divided by the number of outstanding shares. This calculation results in the NAV, which is the price at which investors can buy or sell shares of the mutual fund. Unlike stocks that trade continuously throughout the day, mutual fund NAV is calculated only once, at the end of each trading day. Stock prices fluctuate throughout the trading day, with investors buying and selling at different prices. In contrast, mutual fund NAV is calculated once daily after the market closes. The new NAV is then used for all buy and sell orders placed the next day. This means that all investors buy and sell mutual fund shares at the same price on a given day, regardless of when they place their order. This unified pricing mechanism ensures that all mutual fund investors are treated fairly, with the same price regardless of when they place their order during the day. Mutual funds generate returns for investors in three primary ways. Let's explore how your investments can grow through these mechanisms. Understanding these three primary sources of returns is essential for evaluating fund performance. Mutual funds generate returns in three primary ways: dividend and interest payments, capital gains distributions, and appreciation in the net asset value. The first way mutual funds generate returns is through dividend payments from stocks and interest payments from bonds in the portfolio. Stocks in the fund pay dividends, typically quarterly, while bonds provide regular interest payments. These payments are collected by the fund and can be distributed to shareholders. The second source of returns comes from capital gains distributions. When a mutual fund sells securities at a profit, these gains are distributed to shareholders. For example, if a fund manager buys a security for $50 and later sells it for $70, the $20 profit becomes a capital gain. By law, these gains must be distributed to fund shareholders, typically annually. The third way mutual funds generate returns is through appreciation in the net asset value, or NAV. This occurs when the market value of securities held by the fund increases. Unlike dividends and capital gains distributions, NAV appreciation represents unrealized gains. As the value of the fund's holdings grows over time, the value of each share increases. Investors can choose to receive returns as cash distributions or reinvest them to purchase additional fund shares. Reinvestment is a powerful strategy that allows for compound growth over time. When dividends, interest, and capital gains are used to buy more shares, your investment can grow exponentially. To summarize, mutual funds generate returns through dividends and interest, capital gains distributions, and NAV appreciation. Understanding these mechanisms helps investors make informed decisions about their investment strategy. Understanding mutual fund fees is essential for investors, as these costs directly impact your investment returns. The expense ratio is the most significant ongoing cost of mutual fund ownership. It typically ranges from 0.1% for passive index funds to over 1% for actively managed funds. Load fees are sales charges that can be applied when you buy shares, known as front-end loads, or when you sell shares, known as back-end loads. Front-end loads can be as high as 5.75% of your initial investment. Back-end loads typically decline the longer you hold the fund, encouraging long-term investing. Many investors prefer no-load funds, which don't charge these sales fees at all. Beyond expense ratios and load fees, mutual funds may charge several other fees that can impact your returns. The 12b-1 fee covers marketing and distribution costs, while redemption fees discourage frequent trading. Some funds also charge account maintenance fees for smaller balances. Fees may seem small as percentages, but their impact on long-term returns can be substantial. This chart shows the growth of $10,000 over 30 years with an 8% annual return, but with different expense ratios. As you can see, a difference of just 1.4% in annual expenses can reduce your ending balance by tens of thousands of dollars over time. Let's review key points to remember about mutual fund fees and expenses. By understanding and comparing fee structures, you can maximize your investment returns over time. Let's explore how to buy and sell mutual fund shares. Investors can purchase mutual fund shares through three main channels. First, you can buy directly from the mutual fund company itself. Second, through a brokerage account, which may offer access to a wider range of funds. And third, through employer-sponsored retirement plans, like 401ks, which often include mutual funds as investment options. Mutual funds typically require a minimum investment amount. For initial purchases, the minimum investment typically ranges from $500 to $3,000, depending on the fund. Subsequent investments often have lower minimums, making it easier to add to your position over time. Retirement accounts like 401ks or IRAs often have reduced or even zero minimums, making them accessible entry points for new investors. When you invest in a mutual fund, your money is pooled with other investors to create a larger, diversified portfolio. When it's time to sell your mutual fund shares, there's a specific redemption process to follow. The process begins when you place your redemption order. The fund company calculates the net asset value at the end of the trading day, which determines your sale price. Processing typically takes 1 to 2 business days as the fund liquidates the appropriate assets. Finally, the proceeds from your sale become available after the transaction settles. Let's summarize the key points about buying and selling mutual fund shares. You can purchase mutual fund shares directly from the fund company through a brokerage or via employer-sponsored plans. Initial investments typically range from $500 to $3,000, though this varies by fund. When selling shares, expect the redemption process to take 1 to 2 business days to complete. Both buying and selling prices are determined by the fund's net asset value calculation at the end of the trading day. Mutual fund investors face tax considerations even if they don't sell their shares. When funds distribute dividends and capital gains, these are taxable events for investors holding shares in taxable accounts. Long-term capital gains receive preferential tax treatment compared to short-term gains and dividends. Holding investments for over 1 year qualifies for lower long-term capital gains tax rates, which can significantly reduce your tax burden. Some funds are more tax efficient than others. Index funds typically generate fewer taxable distributions than actively managed funds. Tax-managed funds specifically aim to minimize investors' tax burdens through strategies like tax loss harvesting and limiting portfolio turnover. Investment objectives: alignment with personal financial goals, historical performance, comparison to appropriate benchmarks, expense ratios and fees. Lower costs typically lead to better returns. Fund manager: experience, tenure, and track record. Risk metrics: standard deviation, beta, Sharpe ratio, fund size and growth, assets under management, and growth trend. Independent ratings: Morningstar, and other rating services. By carefully evaluating these criteria, investors can select funds that best align with their financial goals. Index fund funds show 10.2% performance with 0.05% expense ratio, medium risk, and a 4-star rating. Active growth funds show 12.5% performance with 0.85% expense ratio, high risk, and a 3-star rating. Balanced fund funds show 8.4% performance with 0.45% expense ratio, low risk, and a 5-star rating. Sector fund funds show 15.8% performance with 0.95% expense ratio, very high risk, and a 2-star rating. The fund prospectus is a critical document that details the fund's investment strategy, risks, fees, and other important information. Always review these key sections before investing in any mutual fund. A well-diversified portfolio typically includes multiple funds with complementary investment strategies. Diversification helps reduce overall portfolio risk while capturing different market opportunities. By applying these evaluation criteria and maintaining a disciplined approach, investors can build a mutual fund portfolio aligned with their financial goals.